going on, everybody? 360 Digital Closing Bell here. We are live for episode number 43 here on this gorgeous August 34th, 2024, our week look ahead podcast. As always, I am your humble correspondent, Michael Tanner, joined by the executive producer of the show, the purveyor of the show, and the director and publisher of the world's greatest website, oilandgas360.com, Stuart Turley. Stu, how are you doing this morning?
It's a beautiful day in the neighborhood, but it's Monday.
Now talk about t-shirts. That needs to be a t-shirt right there. It's a beautiful day in the neighborhood, but it's Monday. It is Monday. We've got a lot we need to chat about here. We need to do a little bit of a dive into EMP technology trends. There's been some conversations around it, and I'd love to share my thoughts on that. We're also going to have to dive into the crude oil levels. There's a lot of stuff in the international news desk. I mean, Saudi Aramco just discovered some fat oil fields. I mean, the last thing they need is more profitable oil, but guess what? Hey, sometimes better to be lucky than good, Stu. A couple Canadian M&A deals we'll have to cover, sort of our outlook for the oil patch this week, and then always we'll get into the 360 non-official fund. Recording this about 6:31 a.m. Currently, time standard oil trading about 43.33. Futures up overnight, Stu, after some. What's funny is Marco or Hurricane Laura, the actual impact and shutting in production doesn't do anything. Circa the fallout in some of these refineries might not be back online quick enough. Now we're starting to see oil rise a little bit. So I mean, you can kind of see the dynamics that'll play there. But first, guys, this show is brought to us by our friends at Adamantine Energy, and they're really asking the question, what is social risk for the energy sector? Guys, I'm telling you, it's not just community opposition to your development projects. It's everything from the success from the divest from fossil fuels movement to all of the investor engagement surrounding your ESG programs. I'm telling you guys, if you're working in an oil company or an executive in an oil company, you're not taking this stuff seriously. I mean, it jokes on you because really it's everywhere now, moving fast. And I'm telling you, this read says it's multiplying like zombies. That's why your company really needs a strategic partner like Adamantine Energy to help you assess and cover all of this social risk. I love the way they frame that. Talk about framing a question. Adamantine Energy is the leading consulting that's helping companies prepare for all of this social risk. They're led by wonderful human being, Tisha Shul, the former CEO of the Colorado Oil and Gas Association. You guys should also check out their website, energythinks.com, where you can find all things Adamantine. She's got a weekly newsletter that's awesome called Both Things Are True. If you're not reading it, joke's on you. Your competitors are. She's got a podcast called Energy Thinks Podcast, iTunes, Spotify, best way to find it. I'm telling you guys that your competitors are listening. You should do. She's got some wild interviews coming up. I know. I produced the show. Trust me, guys. She's got some wild views. She interviewed the CEO of Williams. Just 2 emails. Boom. Dude was on the podcast. Lots of cool stuff going on. Check everything out. Adamantine Energy. Energythinks.com. The show is also brought by the world's greatest website, oilandgas360.com, where you can find both me and Stu there. Stu hosts a podcast on there, the Energy 360 podcast. You can find that you can find that on iTunes, Spotify, YouTube, wherever you get your podcast. You should also check Oil and Gas 360 out on all the social media channels, Facebook, LinkedIn, Twitter. Stu, who do you have coming up on the Energy 360 podcast?
We got a bunch of them. Today we're releasing Inveris with Bernadette Johnson.
Running today?
Yeah, for today. And then we are interviewing actually this week a company that recycles solar panels. And that to me is very interesting because there's the whole financial reasons around recycling solar. And you and I both know that that's one of the biggies that, the green movement out there says, ooh, renewables are always better. He's got the story. So it's good.
Yeah, I think it's. I'm very interested. You're going to be interviewing this guy, so I'm just going to be sitting on there. I know you actually have another interview coming up tomorrow with some shale people, don't you?
Oh yes, some experts in shale, and that'll be a lot of fun. He's a big guy.
No, that'll be awesome. I'm excited to cut that Energy 360 podcast. Find it on Apple, iTunes, or Spotify, wherever you get your stuff. Yeah, I want to, before we kind of dive into the U.S. patch here, there's been a couple things. First, if you guys haven't gone back and watched the replays of the Oil and Gas Conference, which is hosted by Intercom, I highly recommend doing that because there's so much good stuff you can learn. And if you want to talk about trying to, I think one of the biggest things people always try to talk about is how do you discover what the trends are? How do you figure out and how do you then align yourself with where it is? And then ultimately, how do you get in front of the curve? Because that's what people want. How do you get ahead of the change? Because generally, if you're ahead of the curve a little bit, generally it takes you a little quicker to do something because everyone's vying for your work. Two, you're probably going to pay a little less because people are desperate for your work. No one's, and if you can catch it at the right point, you could really grow and build something that, you look back in 10 years, it's unbelievable. It's, a friend of the show, David Forsberg, always talks about taking a bite. How do you eat an elephant? Well, you just have to take a bite. And then 5 years later, you keep taking bites. You realize I've actually chunked off a lot of this. So at some point you have to start, but, and I want to do that. We'll get into, I really lost my train of thought here. I'm trying to move all my screen. I'm trying to move all my screens around. I think the point with all of this stuff is there was a conversation. If you haven't watched the oil and gas conference, do it because you can start to figure out where some of these trends are. And I think one of the trends that's, I think, in the process of shifting and really already has shifted, and I think did it a little earlier, is this idea of, EMPs and technology. I think for a long time there was this idea that EMPs were really bad at technology, or I wouldn't say bad at technology. That's not the right. EMPs they didn't utilize it per se because it was just an older school industry. I mean, if you compare the energy business to other industries, not necessarily if you work in drilling, you're going to tell me, what do you mean there's no technology? There's a lot of technology, but if you go to, there are other industries that are much more, what I would say, sophisticated technology in terms of moving things to the cloud, doing a lot of different stuff. The whole business was on the internet versus in the energy business, the oil's still in the ground. It's a commodities-based business. And so one thing that was getting asked a lot and has been getting asked a lot is, why are energy companies specifically now not investing in technology? Because there was this push to get them into technology. I don't know, Stu, you were around. It was like 2010 to 2016. There was like a 5-year window where there was a huge push for E&P companies to get more technology into them because there was a lot of capital available, and it was the way to, as it was proven in other industries, you can scale technology at a much more efficient cost than you can individual people.
Yep. Oil companies pay a lot of money for their own internal systems as opposed to letting experts do their own stuff.
Well, yeah, and so yeah, there was this huge time where, companies were trying to internally come up with all this technology, and it really didn't work. And I think as we saw what happened simultaneously 2010 to 2015, do I think these are analogous? No, but I think one's a symptom of the other. If one's a symptom of the other, oil and gas tanked from a capital destruction standpoint. That's really when you started seeing the turn of, pre-2010, I mean, oil was profitable. You can make a lot of money in the industry. Everyone was making money. Investors were making money. Employees were making money. Management was making money. Bond debt holders were even making money. Generally, you don't even see that. Come 2010, 2011, that's when things started to roll over on the energy business. That's really when we started to see prices begin to slump, but also the spending and investment continued. Things shifted from a profitability standpoint to a growth standpoint. So if you're losing money and now all of a sudden all you're pouring money into this technology, you can see. So what you've seen kind of over the past, let's say 3 years, is that burden shift from E&Ps becoming more technology savvy internally, hiring internal analytics teams, doing all this cool technology stuff, building all of this well monitoring stuff that uses new cloud software that, that if you listen to the oil and gas conference, there's 95 companies now providing this type of stuff. And that burden has really shifted over to energy technology, which you can say is a service, but really, I don't even think the big boys, when we talk about Schlumberger, Halliburton, and Baker Hughes, they don't service really the whole industry. They service a select part of the industry. They service 30% of the industry, or I would say 20% of the industry. But the old adage phrase is what? 20% of your customers, pay 80% of your revenue. So that's why you focus on the people who spend the most. So there's a large section of really small to mid-cap companies that smaller service companies that are more mom and pop shops interact with, but also that are prime targets for energy technology companies, which if you've at all listened to some Enercom stuff, and if you've at all sort of kind of been not studying the trends, but have just been around, you know that energy technology has become huge in the past, I don't know, 4 to 5 years, really since 2016. The energy technology companies specifically, before that, it was really hard to find just an energy technology company. I mean, they were some, Stu, don't get me wrong, they were some, but now so they're a dime a dozen now. You walk down in Denver, you can walk into WeWork and just pick out which different energy technology companies. You could walk into a Galvanize down. You could walk into any building. They're everywhere. I mean, you've got 3 specific energy technology VC funds in Denver. You've got, way more in Houston. Denver, you've got 3. It's so, and David Anderson talked about this in his presentation at the oil and gas conference. To bring it back, he mentioned that they are seeing at the top level, because he's an oil field services analyst, he's seeing at the top level, the Chevrons, the Shells, they are shifting their burden of technology internally to oil field services, which specifically, who's he covering? He's covering Halliburton, Chevron, Schlumberger. He's covering probably the top 7 guys. When I'm more the top 7, so that's already happening at the top at the top level. Trust me, it's already happened at the level below it, because at the lower levels you have to do things based off cash. If you own your own stripper wells, you just frack a well when you've got the money. It doesn't matter really what oil price is. You're waiting for oil price to make that much revenue. And I think part of the reason why this shift happened was for a couple reasons. One, technology is just hard to do. Technology is very difficult. It costs a lot of money to start. One, if you want to hire an internal team to do something, you want to hire a decent data scientist nowadays, $100,000. Boom. Give them benefits too. You need to hire a software engineer now to actually, once your data scientist tells you what you need to do, how do you then architect that solution? Well, I need to buy a software. Cool, another $200,000 a year. You need to. Now they need access to all this cloud stuff. Amazon, they give away free cloud softwares to the individual person, so that when me and you go get hired by a large oil company, we need AWS. Well, perfect. Now they can charge that company $4,000 a month for cloud space. Why do you think, MATLAB, great example, the software they give to students for free, get them hooked on it, so that when you go work at your engineering firm, oh, I need MATLAB. Great. They sell a 10,000 corporate license. It's a great business model. I do the same thing. If I have a software product, I was trying to get people hooked. I give it away to students for absolutely free. Let them just run it. Get them used to it. So when they go to a job, oh, I need this software.
Kind of like Microsoft and McDonald's.
Exactly. If you're listening, and that's my one beef with energy technology. Nobody does that. No one's giving away software for free. It's very hard. The big boys are. But there are so many. I could pick out 4 or 5 little softwares that should be in every school right now.
Right.
Because they're easy. They're cloud-based, stuff like that. But that's a conversation for another thing. So I guess my point of it is the conversation recently, and it was posed by multiple people, was why is the energy business not necessarily continue to invest in technology? Well, these for a lot of reasons we stated, guys. It's tough. There's no ROI. The ROI could be years in the future. You want to build I was involved in a project that was looking to do some automated rod pumps on gas wells. Okay, that's a 2 to 3 year project with an ROI that's maybe 3 to 4 years if you can get that thing off the ground. Sure, when the project's done and working, yeah, that's going to save you a lot of money. But how much you have to spend to get there in the hopes that you even get it right? Because that's the other thing about doing. It's hard. Even technology companies can't do technology right. You're going to tell me now an E&P company who can't produce oil profitably is all of a sudden now going to become the world's leading expert at IoT devices? I don't think so. They've got better things, they got better things to try to figure out how to do.
Hey, Michael, do you think, and I'm asking this as since you've got a good analytical financial mind cooking there most of the time. The big change that you have been talking about on our shows is that the investors are wanting their money back faster. CapEx has to, OpEx has to be reduced. So does CapEx. It just expenses need to be done. How much of an impact do you think that finance and investors wanting their money back sooner has influenced the oil and gas industry?
Oh, huge. I think if you're not making money, the first thing you do as an investor is you sit down and figure out, all right, what's the expenses of my company? If you can see a line item that's like when Oxy took over Anadarko. Anadarko had this really cool team. They called it Ice Shale, and I knew a guy on that team. He went to this is I knew you know, he was a former baseball player with me at Mines. So I knew a guy on that team. First thing Oxy did was shut that down. Well, it's easy. It's easy to look at a line item and be like, you're telling me it's $1 million a year? Oh, done. That's an easy G&A to cut or reassign them to other profitable industries. A lot of those guys got jobs elsewhere, unfortunately, because that's what happened. So
Their own company.
yeah, exactly. They started their own company. I mean, trust me, those guys were paid well. It was a small team, but there was a lot of resources put in. They were really trying to map they were trying to do some really interesting stuff. I won't say too much about what they were working on because I don't know how much I'm allowed to actually say. This is helpful to play baseball with guys. You can text them and chat about stuff. They'll be a little loose. What am I trying to say here? So to kind of answer your question, Stu, yeah, I mean, I think if your technology is the easiest thing to cut if you're an E&P company first, especially technology development. Yes, you're going to need an IT guy. You're going to need probably an internal IT guy. I think the problem is I think this is the first downturn really in which, and I think other ones have been, but I think over the past, I think 24 months is when you've seen the burden of the technology switch in swing. And if you talk to any energy technology startup right now, they're busier than ever. I mean, we talked to a bunch of them. We've got some coming up with Engage Mobilize. They just put out a case study with Noble Resources. I mean, they're busier than ever. I'm telling you guys, the oil and gas companies, in my opinion, and E&Ps, we'll move on at this point. They can't even do They can't even do profitable oil right half the time. They need a lot of things to go right to do that. Why are we then going to task them as an investor with developing technology? It just doesn't make sense to me. So to answer your questions, I think it's an easy thing to cut, and it's not even their core business model. I mean, one of the good things, we talked about this, I think, before the show started, which was about knowing what to do internally and knowing what to contract out is a really tough decision, and sometimes makes a good leader.
Oh, absolutely. And one of the things, Michael, that I found when I was working on some of the fields that were bought by BP not too long ago, they were looking at changing from CapEx to OpEx because of their financial statements. So CapEx was they're building out their networks and building out all their stuff. Well, they subcontracted that and became OpEx. So a lot of that is also driven by the financial statements of an accounting guy sitting up in the middle of nowhere.
Oh yeah. So all in all, that burden has shifted. If E&Ps are not going to be technology innovators internally, which I think is great if you're an energy technology consulting shop, if you have a product, if you're just a consultant, if you have experience in analytics and data science, software engineering, now could be the easiest time. And trust me, if once you read about it in Reuters that it's the time to be a contractor, it was too late. So get it before the Wall Street Journal gets written, the article gets written in 18 months about how it's time to be a contractor in the energy business. Trust me, the time's then over. So you want to get in now and make your money while you can before you shift and the wave changes and you get rehired because in 18 months they decide to hire me. Because that's what I'm saying. Who knows? Knock my mic over. Who knows? In 18 months they could start, not that they should, but they could start hiring everybody again if you're an analytics guy. So just know when that Wall Street Journal article comes out, it's too late.
You look like you're dancing like Elvis there with that microphone dip.
I got a new. I keep always looking down at the old camera. I got to realize new camera's up here. So, all right. Well, let's move into let's just go and move into to the oil levels and crude oil share. As always, guys, this segment is sponsored by Sandstone Capital Group. These guys do great work. Just check them out. SandstoneCG.com, 949-561-1818. I mean, really, in terms of this, there's a couple stories that happened over the weekend that aren't necessarily U.S. shale stuff. Honestly, the two things that happened are our brethren in Canada and Aramco. So I think we start, Stu. What's going on the international news desk right now?
Um, Boy, there's a change. There's a bunch of stuff.
It's more lit than the U.S. right now. I mean, really, there's no really this weekend. I don't really think any large stories happen. I think the three biggest stories are on the international side, and I really think more as we look forward. Obviously Dakota, but we'll get into. I think the international news desk is pretty much all we've got.
It's crazy out there right now, Michael. And when you take a look at the first one I want to hit on, we'll go back to Saudi Aramco because that's huge. You and I have been talking about all those ships from from Iran selling to Venezuela, and it's because, Venezuela screwed up because they're socialist. But the U.S., we just put out an article that the U.S. seized 3 different oil companies' websites, and it's because they found Iran's sources going with all those tankers because they seized 4 tankers not too long ago. Well, now they shut the companies down.
What are the names of these companies?
Well, let me pull it up. I knew you'd ask that.
Well, yeah, because I want to know now. Who are these? Let's make them famous.
Oh, you bet. It is Bubbling International, Solar Fuel Trading, and Oman Fund Trading.
Sounds like real reputable stuff right there.
Anyway, the domains were seized, and that usually is the sign that all of the federal activities already happened.
Yeah.
SWAT teams have already.
SWAT teams popped in.
Yeah. Oh, by the way, retro. So, and then Saudi Aramco had 2 interesting stories. You had alluded to one of them, and that is the discoveries in the 2 oil fields north of the North Kingdom. It's kind of like they need more oil, but there's a little bit of a difference in this field is that it's got condensates, and it's also got natural gas. In that section of the west coast, they do not have much natural gas infrastructure at that point.
Mm-hmm.
So it's nice for them to develop out their natural gas pipelines at that side. So internally for Saudi, it's a great thing. They need more oil.
No kidding. And it's a fat field. I mean, it's and cheap, profitable oil to produce. Unbelievable.
Yeah, they don't have to drill horizontally. They just have to drill like a foot. You and I could find that oil. And the other one is we ran a story last week on Saudi Aramco. They were having top-down changes. One of those CEO of Aramco's financial team, investment arm, had to leave, and he's like, there's kind of some questions on that. We ran that one on
what are the questions?
They had questions. It's one of those that they.
Oh, I see. That's what they released down. Okay, that's fair.
So whenever you leave and they say he was a good guy, it's for a good reason. He's going for a better job. But when they say it's questionable,
yeah, it'd be interesting. We'll see. Who knows? Who knows? But no, I mean, Saudi Aramco, man, it's nice to be them.
Yeah, they reached out to us, and it's kind of fun to. We're looking to get some interviews set up with them.
We're looking to 16 million feet of standard gas. I love it. Good for them.
Oh yeah.
Good for them. So, yeah, and on the U.S. shale side, really no real stories happened this week. I mean, I think there's 2 things that we'll call Canada, U.S. for now. Whitecap Resources has entered into an all-stock transaction valued at approximately $155 million to buy NAL Resources Limited, which is a privately held, wholly owned subsidiary of financial services company. They have oil and gas operations in Alberta and Saskatchewan and are currently producing about 27,000 barrels of oil today, 55% oil and NGLs. 58.3 million shares will be deployed. Closing date January 4th, 2020. But here's the best part. Now Resources Limited, no outstanding debt after the transaction.
Ooh.
So talk about a strategic combination. Whitecap Resources. I mean, this is just, it's it's tough to find data on these guys because the Canadian production information is pretty slim. I don't know the best ways to go. All the stuff that I subscribe to is more U.S. based. But looking at their balance sheets too, the fact that they can get into this and have no debt when Whitecap is already working with a decent debt is not bad. There's also 80% of their current asset base, flows over with this. So which is a really, it's talking about synergistic. And it decreases their leverage ratio. Here we go. Decreases their leverage ratio by 25%, which is great because you know what that means? You can go borrow 25% more because that ratio is what allows you to borrow more. Good stuff.
That's nothing like, let's see here. It is PetroChina lost 4.4 billion, and their debt structure is, again, I have to go look at what their debt structure is. So let's take this article and this news story and this company versus PetroChina. 4 billion loss and huge debt versus this one. I'll take this one every day.
Oh, no doubt. I would read the PDP numbers off, but who knows if that's in it? Who knows if that's ever true? But I mean, another Canadian M&A. I think you're going to continue to see more of these. There's also a story in the Oil and Gas 360 News Desk about Obsidian Energy attempting to combine with Batera Energy. You guys go and read all about that. Another Canadian company here. They've been working on this for a hot minute, though. Sounds like this has been about a year. They think it's going to go through, and now they're basically just kind of working on the terms of the agreement. I think when we move over to the levels for crude oil, like I said, it's 657 right now on August 31st, 2020, last day here before September. Thank goodness it's not April. Oh, how naive we were in April.
No, but it is Monday.
It is Monday. Great. 43.34 for crude oil. Big levels I'm looking at 41.36 and the downside 41.87. If you're looking to get long, I think it's a good level. Then again, it's only about $2 we're trading at. 40 control for the week 42.68. I like $43 even. 43.33 like what we're trading at right now is a good level. I think our cap is 43.80. I think it's really interesting on what's going to happen with this refining information. I think on Wednesday we're going to see the crude oil numbers. They come out from the Department of Energy. We're going to see what inventories are at. Specifically, we're going to see where refinery utilization's at, which is going to be interesting. All of these are now the ones that are shut down from Hurricane Laura. And we're also going to see U.S. crude production. I mean, probably going to be down in the 9.5 million range, but will be very interesting to see what happens. Watch out if you're trading that. I don't know if I'm actually going to trade this one this week. I thought about trying to get back in the seat, but the dynamics have changed so much that it'll be very interesting to see what comes out. I think the API that drops tomorrow at 2:30 will be very interesting on the crude oil standpoint. Very interesting where they see crude oil production. Thursdays we're gonna get natural gas inventories, which I think are gonna be a little more bullish than our brethren on the oil side because there was just less natural gas had to get shut in from both a production and a refinery side because of these hurricanes. I think when we look at Friday rig counts, we'll probably see rig counts stay very flat. I think the next 2 weeks for the DOE will be very interesting. I'm just watching M&As. I mean, really, it was a quiet weekend, which is probably good. It's been wild on the U.S. shale side here. Good to see a nice quiet weekend. Stu, are we missing anything on the oil side here?
I think we did a pretty good. It's not like we did the other day around the world tour, but
no kidding. Get me air sick. We'll go ahead and dive in here. to the 360 official, non-official fund. But first, guys, the lawyers make us say this so we don't get sued. Guys, this segment is for entertainment purposes only. Neither me, Stuart Turley, give investment advice. We are not investment managers. We have not invested our money for our own account. Remember, investment is risky, and you can and will lose all of your money. That being said, Bonanza Creek looks really good on the fund side. Our natural gas fund looks very good, even though we're down about 2.5% daily. But that whole fund is up about 15% on the nat gas side. So hopefully it continues to run. I'm not sure. I think we're trading at natural gas is trading at 258 right now. People are saying 390. I don't buy it. I think $3 is the cap right there. But then again, I never buy much that you hear out. Stu, how's your stuff looking?
LNG's up 0.81% this morning. Geopark's up. Enphase is actually heading up. Devon, I'm looking pretty sporty on that. The one TPL I have not bought yet. It is down 1.14%. I got a long way to go, but I think that's a great one to keep an eye on. TPL. Yeah. Texas Pacific Land Trust. I think that one's one to watch.
Cool.
It needs to get down around to the 490 range. I think it's going to get there.
Okay. But you're long.
Yep.
I like it. Well, good to know. We'll have to get Tomcat next week, see what he thinks. But we're about 30 minutes here, guys. Short show. We're going to let you get out of here, get back to work. Thank you for checking out the 360 Digital Closing Bell here on Oil and Gas 360 and the world's greatest website, oilandgas360.com. We'll see you guys this afternoon for the Digital Ticker.